Good morning, Ron.
Hi, Kath.
We
Morning.
got a we got a great show today.
They're all great. This is
I
a really
know.
good one, though.
I know. So
This is
what is
about our future. How could it be any more important?
yeah,
We all have a
right.
future.
So what did your friends tell you about what are we doing here with this? Let me a sober look at our future. Are you sober, Ron?
Um, for the moment, yeah. That's so. Our friends are going to watch it because they all said, "I'd like to see what you look like sober."
Well, let's see here. Oh,
This
not
is it.
bad.
Yeah,
Yeah, not bad.
should should frame that.
Yeah, exactly. Okay, well, why don't we go right into what the show is about here, okay?
Sure.
Optimistic versus realistic.
Yeah. So I've been watching and listening and reading all of these forecasts for this year and for the decade, and it's really been interesting this time, and I've done this every year. January is a time when people start getting out their crystal balls and telling us what the future is going to be like. And what I've found is that every one of the things I've been listening to is predicting a terrific 2021. Everything's going to be great. The um, vaccine is going to cure it. The economy is going to recover. Just jump in now before it's too late. In my personal opinion, as anybody who's been watching our show knows, I don't. I think we got a lot of troubles ahead of us, and I would love to see these forecasters be right. That no, it's a great economy and the markets keep on going up. But I don't think so. And one of the things I've observed is on the next slide, Kath.
Okay, hang on a second here. Okay. Oh, that's what you observed.
Yeah, this has really been an interesting time. So most years in January, and people are forecasting things, there's pretty much a consensus. Everybody has a very similar view about what lies ahead. But this year is what's called bimodal, and the way this graph works is the horizontal scale is rate of return. So the high rates of return for this year are over on the right, and the low ones are over on the left. And then the graph shows you how many people are having the two different views. And the spike there, way on the right, is most of the things I've been listening to are very optimistic. So the outlook is really optimistic. And I took a closer look getting ready for the show, and virtually all of those really optimistic opinions are from investment management firms, people who run money. If you go to the left, most of the people who have a less optimistic view are investment consultants, investors, and we all have this bias. Behavioral scientists tell us we have this bias called confirmation bias. So if you want to think things are going to be rosy, you want to open up all the forecasts that investment management firms are putting out. So Goldman Sachs is very optimistic. JP Morgan is very optimistic. If you like something less optimistic, and maybe you're thinking you're concerned, and I think you should be, there are websites where consultants and investors share their views. And one of the fun things about those websites is there's always a lot of comments. So you get to read people who agree, don't agree. And I'm going to tell you a few of those websites because I think they're really fun and I think you benefit. So Seeking Alpha is one, and that one is global. Advisor Perspectives is another that's, I think, pretty much just US. And then I'm going to talk a little bit about one called Peak Prosperity. So, and there's more than that, but what I'm really saying is two sets of view. One set is really dominated by investment management firms. The other set isn't nearly as many people, but it's less optimistic. And what I want to talk about, I have the less optimistic view, so I'm going to tell you what I think is going on. And I'm going to I'm going to prove this statement. So the investment management firms are optimistic about two important things about looking into the future. One of those things is they view that the current high prices of stocks, stocks are really, really expensive right now by just about any standard, and I'm going to talk about that. But their forecasts say that's going to stay the same. We end up being willing to pay really high prices for stocks. And then the second assumption that they need to be making in order for their forecasts to sort of make sense is that earnings will grow nicely in 2021, more than 8%. The historical average is 6%. Now, that view is probably right because we're coming off of 2 quarters where earnings have been declining. So when the vaccine really starts working, things are going to start coming back. So earnings growth probably will be high, but it's coming off of a low point. But uniformly, two things are going on in these forecasts. One is they never talk about the risks. So the only mention of COVID is it's going to go away. Nothing about the after effects, the recovery. People will probably never get their jobs back. Never mentioned. And
Oh
the
my
other thing,
gosh. Well, that's not so good.
I'm going to use the word gaslighting, and I think we're being
Yeah.
gaslighted. I'm going to say that in the next slide, but all of them say the Federal Reserve is going to fix anything that goes wrong. So don't worry, even if they're wrong about their forecast, the Fed is going to step in, and it's all going to be rosy. And what they really mean mostly is that the Fed's going to throw money into the economy. And we're going to talk about that today about, is the Fed really doing us any favors? I think they might not be. And I'm going to tell our viewers why we could be in trouble. So on the next slide, I want to show you some of the forecasts that these investment firms are making. So you can see in the schedule here, the expert, and these names are very well-known names. And the firms who are making these forecasts in the next column, JP Morgan, Goldman Sachs, UBS, BMO, very well-known firms. And they show the target for the S&P at the end of the year, but the important thing is the rate of return in the last column. So the average rate of return over the last 95 years on the stock market has been 10%. So 3 of these prominent firms are forecasting above the average. The others are forecasting below average, but just a little bit. I mean, even a 1% return in an environment where we're being crippled by the COVID, and there are so many other things that could go wrong, it is still, in my opinion, pretty optimistic. So I wrote an article that it basically says we're being gaslighted. And that, by the way, gaslighted has become a word in the dictionary. And it's based on an old film called Gaslight, where the husband really screws with the wife's head and makes her think that she's going nuts, that everything she thinks she knows is wrong. And it reminds me of the Star Wars movie where they talk about a Jedi mind trick. These guys are trying to mess with our minds.
Yeah.
They're
Sounds
really
like it.
they're really saying, if you're worried about COVID, don't worry about it. There's a vaccine. If you think the markets might correct, don't worry because the Fed's going to step in. It's all
Yeah.
going to be good. So no, it's all right. So I do want to emphasize that by just about any measure, the stock market, the U.S. stock market, is at an all-time high. Never been higher. And on the next slide, I want to explain why. And also, when you listen to these investment manager forecasts and you say stocks are at an all-time high, their response almost all the time is, yeah, because interest rates are really, really low. And what they're really saying there is, if you're an investment analyst and trying to figure out what a stock is worth, what you're trained to do in school and in the CFA program, Chartered Financial Analyst program, you forecast the earnings on that firm through time, maybe out the next 20, 30 years. And then you discount those back using a discount rate and you come up with a price. And if that price is less than the current price, you buy it. If that price is more than the current price, you sell it. If you use a low discount rate, the price you're going to come up with is pretty high. So these folks are absolutely right. The low interest rates justify higher stock prices. Absolutely. But I've done some work on that, and I think I'm pretty close to this. The currently low discount rates should have increased stock prices by about 50%. So if your stock was worth $20, it should be worth $30 today. But the stock market is up 400% in the last 10 years.
Wow.
So some part of that is explainable by low interest rates. The other thing I'll say about the explanation about why it's okay for prices to be so high is that's all already baked in. So the current prices aren't going to go up anymore because I don't think interest rates are going to go down anymore. If they do, they're going to be below zero, which is possible, but God forgive, that'd be terrible if they were to do that. So the interest rates are the primary driver, but let me tell you just the behavioral things that are in there. And there's another behavioral bias that's called recency bias. So behavioral scientists, I think, tell us a lot about why we behave the way we do. But recency bias says whatever happened in the recent past is something we tend to forecast continuing to happen. So we have 92 million millennials who might know 2008 happened, but they weren't invested in 2008. So all they know is the last decade when the stock market only goes up. And all they know is that the pundits in the first quarter of last year when the market went down, all of the money managers would say, buy the dip. This is your opportunity now. Jump in because it'll never be cheaper. And they did. So now, last year, the stock market was up 18%, I'm sorry, 14.5%. In a year when the economy was in the tank. So this behavior is what's helping the market up. The rationalization is low interest rates. And then there's other effects too. It's not just the millennials. So back to that slide, please, Kath. We have these FANG stocks. It's Facebook, Apple, Amazon, Netflix, and Google. Those stocks have gone to represent more than 35% of the stock market, just those 5 stocks. And investors have run to those, I believe, sort of in the herd instinct, but also with the thoughts that whatever last breath this market might have, it's going to be in the big stocks like that. So those stocks are going up like crazy. Foreigners are flocking to the U.S. stock market. They currently own 30% of the U.S. stock market, is more than they ever owned before. The Federal Reserve has pumped $7 trillion into the economy, with another $4 to $5 trillion, I'm going to talk about this, coming in for COVID. So the original concern about quantitative easing that started in 2008 was that it was going to cause inflation, but it didn't. But it did cause inflation, but not in the way we normally measure it. We've talked about this in prior shows. All of that inflation happened in stock and bond prices. So those prices are inflated by quantitative easing. What I'm saying is the consumer price index hasn't moved at all because that's not where the inflation is. But when we start doing helicopter money, COVID relief, that money is going to get into the economy to the common person, and we will see increases in CPI. And I'm going to talk some more about that. Then there are these sort of short phrases. I call it hopium, which is the belief that everything's going to be okay. And I think it's that message is really being delivered mostly to the millennials. And certainly greed is just a common thing to drive markets. And it's called FOMO, fear of missing out. And the election was a wild card, but I just checked before we started the show. The market is up 4% since Joe Biden took office. So if you're looking for an early indication of whether a Democratic Congress and Joe Biden and everything else are good or bad for the economy, 4% in a few days is a pretty good indication that the market's reacting positively. So those are the reasons. You sort of say, how can there be a bubble? They happen. Bubbles happen, and these are the reasons why they're going on. So now I want to get to the forecast that we started out with and why they are what they are. There's this formula that always works because it's what's called a tautology. So you can take any period historically, the last 5 years, pick the decade of the 1930s, whatever time period you want to pick, and you can explain why the returns in that time period were what they were. And they always are this formula. It's basically the dividend yield, the earnings growth, and then the wild card is behavioral, and it's the price earnings expansion contraction. What that really says is it's the willingness of investors to pay up, pay extra for stocks, a very high price for stocks, which is where we are today. Or if there's a price earnings contraction, it's where investors have decided that prices are too high and they need to come down. So I've developed this matrix on the next page, Kath. And there's a lot of numbers here. Can we possibly get the whole thing on there, Kath? Just at least down to the green area? No? Okay, I'll just tell it what it is then. That's fine. That's fine. So on the left-hand column, I have different levels of price earnings, and the current price earnings ratio is a little above 30. Now, some people who listen to the show are going to say, no, it's 25, or no, it's 20. There are many ways to calculate the price earnings ratio, and the one that I think is most accurate is really actually above 30, and I won't go into the nuances. So we're there right now at the lowest level of the 30 price earnings ratio. And then earnings growth is across the columns, and the average earnings growth over the long run has been around 6%. So if we go to the lower right there, I know you can't scroll, Kat, that's fine. That was fine the way it was. Thank you. So the forecast of returns, perfect, thank you.
Yay!
Hey, so the return forecasts are in the range of 0 to 14%. The only way you can get there is to assume that the price earnings ratios are going to stay high. So that investors are going to be willing to pay a premium for stocks. And part of that, I'm just to reinforce, is a belief that the Fed will step in, that they'll keep the interest rates really, really low. So that really needs to happen to keep the PEs that high. And then the second assumption is that earnings growth will be above normal, say in the range of 18 to 24%. That's a realistic assumption because, again, we're coming off of a real hit to the economy. When things start to recover, earnings should recover really nicely. So that's realistic. So the unrealistic part of this is that price earnings ratios will stay the same. If you'll consider that price earnings ratios might return to normal, the normal level is 15, and earnings growth is roughly around what normally is 6, we're going to see a 50% loss in the stock market. Now, one of the things about this particular way of structuring this matrix is this is what will happen this year if PEs stay the same or if PEs go down to 15. What probably will happen is this movement to more realistic prices in stocks will have a bubble slowly deflating. So it'll probably happen over the next decade. But I'm going to talk about things that could burst the bubble. And if the bubble bursts, that really means that we go down to a more normal pricing level and a 50% loss in the stock market. So I want to couch my opinion here with, I think we're going to get back to more realistic levels. If it happens quickly, it's like stripping the bandage off right away, and we're going to have a big loss in the stock market. But I sort of hope we don't. I hope it sort of moves on through time. But on the next slide, we talk about what could burst the bubble. And disasters. Disasters will cause things to burst the bubble. And there's one publication, Peak Prosperity, that you just barely see on the slide, but it's one that has a lot of different contributors. Some of them more optimistic, but generally they're pessimistic. And then there's a professor at Boston University, Lawrence Kotlikoff, who has been writing a lot and is getting a big following, sort of telling us what the real debt is. Because I think we're being fed misinformation about the true level of the national debt, not just our debt, but debt around the world. So Larry's going to be our guest on the next show. So we're going to get it right from the horse's mouth. But on the next slide, we did this on our second episode ever. So it was several months ago. And by the way, our second episode is one of our most viewed episodes. And it's about the threats to the stock market and to the economy. And in the upper left corner, we sort of summarize them. Believe we were just at the time recognizing that COVID was a pandemic and not really dealing with how severe it was going to be. Now we know better. So that was one of the threats. Stock and bond market bubbles we talked about. We talked about the world debt. There's a debt crisis. And then other things like there's the nuclear threats that won't go away. We were in trade wars with China and Europe. That probably is not going to continue so much under the Biden administration. Hyperinflation was definitely a threat. And then we talked about what Dr. Kotlikoff talks about as well. Social Security and Medicare are on the brink of bankruptcy. So Medicare should go bankrupt in 2026, Social Security in 2034. And I've gotten so much feedback on that is they say, well, it won't go bankrupt because we'll just print money. And that's true. We can do that.
Yeah, that's what everybody thinks too, that, well, we just have to print more money, just print more money. Where are all these trillions coming from?
Well, we've talked about that in other shows. I'm going to talk about it again in the proper place here. But the printing money, I'm just going to say it here. I'll say it one more time. We are poking the bear. So we're printing money and printing money and printing money. And everyone knows that some amount of money is just going to be disastrous. And it's going to topple the whole house of cards. But nobody knows what that number is. Nobody. I saw Warren Buffett on an interview some months ago, and they said, what do you think about all this money printing? And he goes, no one knows. It's an experiment that has never been run, certainly not of the magnitude it's being run. But I know we're living dangerously. We really are. So on the same slide, Kath, I wanted to talk about two things that really highlight it. So I think there are many scenarios that could pop the bubble rather than deflate it, but really pop it. And the one I want to talk about is how the world debt crisis can sort of lead to serious inflation. And then that in turn will lead to popping the bubble, the stock market bubble anyway, and certainly the debt market bubble as well. So as a lead into that, on the next slide, I want to talk about something that I found a picture that I thought was really fun. So in this left-hand corner, do you recognize the persons there? Do you know who that is? I can't hear you, Kath. Did you mute yourself?
Oh, yeah, that's the guy from Mad.
That's Alfred E. Newman from Mad Magazine.
Yeah.
But he's wearing a Harry Potter outfit.
Yeah. So magic.
Yeah. So the Wizards of Wall Street say, don't worry. And that's really what's going on here. And the baby boomer over on the right says, wait.
Yeah. This is my money. This is my money. Yeah.
Yeah. You can't have it.
Yeah.
So regardless of who is right about the forecast, whether it's going to be, a great economy or terrible economy or whatever, baby boomers' number one investment objective. This is our very first episode about the basics of investing. Their number one investment objective should be to not lose their money. So even if I'm wrong and the market soars up, they should not be risking their money, and they are currently. We talked about that too. So on the next slide, I'm going to tell you.
Hey, can I just add something in here, Ron?
Sure.
Don't you think that a lot of times it's because the baby boomers in particular, they want to rely on somebody else to do their investments because they want to trust in them rather than trusting in themselves? I know that's how I would feel, that I'm at an age where, I forget things. I don't know whether I'm doing the right thing, and I'd feel much more comfortable in talking to the professional about doing it.
Yeah. I just forgot. What did you say?
Yeah, right. Huh?
No, it's
what
funny
am I talking about? Where am I?
Yeah. No, it's I reminded our viewers now that our first episode is about the basics. Baby boomers should be protecting themselves. Second episode was about the threats, and then exactly what you said, Kath. We got feedback that said, "Well, I'm not making my decisions. I'm relying on my investment advisor." So our third show was on the 70-year history of investment consulting. And there's a common answer that investment consultants use, and the history sort of builds up to why it is what it is, but the answer is 60% stocks and 40% bonds. And that probably worked really well until the baby boomers came on the scene. There have never, ever before been 78 million boomers all living in the risk zone at the same time. And that answer for them is not 60-40.
When you first said that, hey folks, for those of you that don't know, I'm the novice here when it comes to financing or financial situations. So this show is really for people like me, so that I can be educated on what's really happening. And it really is true. Why would I want to believe that I fall into a cookie cutter? Everybody is individual, and they should have their own personalized, customized portfolio, don't you think?
Yeah, absolutely. And I'll just say, I think who we're reaching out to are not people who are dumb in any way, but most
Oh, well,
people.
thanks.
Well, you're not dumb. That's my point.
Yeah.
But you're not educated in finance or investing or
Right.
anything else. And the smartest thing for people who aren't educated is to rely on people who are.
Right.
Right.
So it
And
gets scary as to where do you find those people?
well, that's the thing. Investment consulting is what's called a creeds good. And what that means is it's just like going to your auto mechanic or calling the TV repair guy or anything else. You don't know if he does know anything. You don't.
Right.
So it's all a matter of trust.
Yeah.
And that's why I did the third episode there are some really good consultants, but you won't know which ones are good and which ones are bad.
Yeah.
And
So you go on somebody referring you to someone
there
that
are websites that help you do that. Paladin is one that I work with that is very good at that. But the consulting industry has pretty much been trained, and this is a real shame, that 60-40 is the answer.
Oh, wow.
And if everybody can get that into their head and look at their portfolio, and if it's 60-40, they should really reconsider if they're a boomer.
Red flag, red flag.
Yeah. And anybody else, 60-40 is probably a close enough answer.
Yeah.
But not for the boomers. So
Okay.
actually that's I want to reinforce that what we all go through, and the green line on the top and the left-hand side here, is we build up our savings through time, and then we retire, and we spend those savings. So the green line goes up, and then it goes down. At the same time, in the bottom chart, what we can do is early on, when we have $10 in the bank, we can take a lot of risk. Losing half of $10 is only $5. But as our money grows, we really should move to protect it. And then at the very bottom there is where we're transitioning from working life to retirement. And that's when we should be very, very safe. And by very, very safe, I mean put a number to it, but I mean 70% in safe assets, very, very safe. And then recent research has suggested something that is really revolutionary, and we'll see if people actually start to sign on to this prescription. But the argument there is when you're in retirement, you need to be safe for about the first 5 to 10 years, because that's critical. But once you've been in retirement for a while, you can start to re-risk, get back into the stock and bond markets. And that action is designed to extend the life of your assets. So the number one thing you want to do is protect as you're transitioning from working life to retirement. Don't lose your money. And that's called sequence of return risk. You can Google that and it'll tell you a lot about that. Most people don't understand sequence of return risk, but if you take 10 minutes, you'll get it right away. So be safe then, and then you can re-risk later on in life. And then the chart on the right is just to remind us that it wasn't that long ago, 2008 in particular, when 60-40 lost 35%. So just imagine what you've saved today. Take that number in your head, and how would you feel if you lost 35% of that in a very short period of time? I know I wouldn't feel good.
No, not at all.
Well, I'm going to say 2008 was a real kick in the head for most of us, including me. So we didn't dodge that bullet. Most people didn't. So on the next couple of slides, I want to talk about what your asset allocation should be. And again, this is sort of a repeat of previous shows, but this is the context now. We're looking to the future and saying, no, number one, whether we're right about being concerned or wrong about it being concerned, baby boomers should be protecting their assets. So on the left-hand side, 60-40 is what EBRI, the Employee Benefit Research Institute, says is the average mix for older people. By the way, it's 60-40 for 20-year-olds, for 40-year-olds, for 60-year-olds, for 80-year-olds. Everybody is 60-40. Isn't that amazing? Same asset allocation.
That is unbelievable.
Isn't it?
Yeah.
But that study is for real. Anybody can find it. This EBRI, Employee Benefit Research Institute. What we've been recommending is what I said just a minute ago, that you should really be 70% in safe assets for that transition zone. So the 5 to 10 years before and after you retire, you should just, your number one objective should be don't lose it. Just play it safe. Now, another thing, another recommendation that I thought was cool. So there's a recommendation in the Bible on the next slide. So if you want to be spiritual about your decision, these words are in the Talmud, the Jewish Bible. Let every man divide his money into 3 parts and invest a third in land, a third in business, and a third let him keep by him in reserve. So that's basically a third in stocks and bonds, a third in real estate, and a third in very safe assets. So that's safer than 60-40. It's not the 70% safe assets that we recommend, but that's another way to sort of think about, if you're 60-40 now, where you should move to be safer. Now, the next slide really introduces a new wrinkle on being safe. Normally, you would think that treasury bills, or even putting the money in your safe deposit box or in your checking account, would be safe. Cash should be safe. And that introduces this whole thing about what is money. And on a previous show, we talked about cryptocurrencies. So money is a store of value, number one. And number two, it's a vehicle for exchange. So cash meets that unless we have hyperinflation. So if we have hyperinflation, cash is no longer a store of value. And let me put it another way. Those pieces of paper in your wallet, they only work if we all agree that they work. Otherwise, they're just pieces of paper. So the bear that we're poking right now could easily cause people with pieces of money to basically throw that money in the garbage.
Because it's all about trust, right?
It's all about trust.
Yeah. Yeah. So if we don't trust in the dollar, then it becomes worthless. Right. Same thing like trusting in cryptocurrencies, which was a great show, by the way, Ron.
Yeah, I liked it too. It was a lot of fun. So yeah. People are watching this, you go watch the cryptocurrency show. We had Maury McCoy on there, who really knows his stuff. So on the next slide, I wanted to sensitize our viewers. So we've put $7 trillion in quantitative easing into the economy. And we're going to spend another $5 trillion probably. So we've already spent $3 trillion, and Biden is going to put at least another $2 trillion. And that's 25% of GDP. And what's shown in the graph here, it comes in 3 flavors, but the bottom line is we are planning to spend 25% of our gross domestic product to fight or to give relief for the COVID. And Biden is calling it a moral imperative. It probably is more of a moral hazard than it is a moral imperative. Among all the countries, I would have expected Japan to even go more for it than us, because they've been the spender. They started much earlier than us, spending a lot of money to buoy up their economy. They're going to put in a little more than 15% to put in COVID relief. So we as a nation are spending a big portion of our wealth, 25% of our wealth, as measured by GDP, gross domestic product, to relieve COVID. So part of what I'm saying here is when the vaccine gets into enough arms, this isn't anywhere near ending. So this is sort of closure on the disease, but there's still a lot of economic things to deal with, and having 5 trillion sloshing around the economy is going to be problematic. And on the next slide, I get into the details, which is, I think, pretty interesting. So we had a high risk of inflation before the COVID, and it's manifesting itself around the world in those circles around the middle: bond defaults, currency devaluations, negative interest rates in some countries. The graph on the right is really, really troublesome. So let me spend some time on it. It's the money supply, and the money supply normally grows at around 6 to 7% per year, and that's what the economy needs to keep chugging along, and it doesn't cause inflation. It's just about the right amount. For the last decade, it's been 14% a year. But what you can see with that curve is it was running at about 6 to 7% until we started quantitative easing, and that there's a definite increase there. But on average, it's been 14%. That didn't cause the inflation meter to go up, as we talked about. Putting another 5 trillion into the economy in a very short period of time is going to cause an increase in the money supply of 27%. And that's going to be helicopter money. Now, some people who have written about this they say, so the government's going to send us our own money back. What's the big deal there? I send it in, they're going to send it back. That's my money anyway.
Yeah, no, I never thought of that. That's true.
Well, it's not.
Oh, it's not true.
No. All this money that's being sent out is new money. It's not the money you sent in.
Okay.
And we have a slide from the previous shows, Kath, but the way this new money is being created is just incredible. So what happens is we don't print money. The Treasury borrows money. So when you got your check, it said Treasury on it, right? Mine said Treasury.
Yeah.
Yeah. So the Treasury issues the checks, and they borrow money to write those checks. So it's not your old money. It's not anybody's money. It's brand new. And we borrowed it to send it to you. But,
oh, great.
but normally there's a list of entities that normally buy new Treasury issues. Some foreigners buy it. U.S. citizens buy it. The Federal Reserve buys it. Currently, the normal buyers of treasuries are tapped out. They're not buying treasuries, or just a little bit of the treasuries. The Federal Reserve is buying it all. So what is going on there?
Yeah.
We're issuing money and we're buying money.
Yeah. What is going on?
We're
Do we
making
know?
money up out of thin air.
Okay.
So I'm going to keep using this. We're poking the bear.
Wow.
At some point, all this funny money that's being manufactured out of thin air is getting into the economy, and it's just pieces of paper. And as long as we have trust, I guess this is going to work. But there's some limit. We're just going to go over the top. And I'm going to talk about inflation versus deflation. But on the next slide, I think it's really problematic and indicative of what's going on here. So the day before Janet Yellen testified before Congress, the press picked up that she's telling Congress that we're not going to let the dollar get weaker, which basically means we're not going to print money. But we are. She told Congress we're not going to let it get weaker. I mean, if we're printing money, we're getting a weaker dollar. But that we really need to step up and print money to put at least $1.9 trillion in COVID relief. And that's just plain double talk. You can't have it both ways. You can't print 1.9 trillion and still have a strong dollar. So Janet Yellen was the former chair of the Federal Reserve System. Now she's the new the Treasury Secretary. So she's been in the place that's been buying the money. Now she's in the place that issues debt to create money. So she knows she's sharp. And I think she knows what she's doing. But I'm not sure the rest of the world understands where we're going. So on the next slide, I want to talk about, whenever I bring this thing up, we are currently very much in a deflationary environment. And there are several really strong factors that should keep inflation under control. One of them is really bad, but it's real. There's a huge wealth divide now. And the wealthy people, most of the money is with them. So they're not doing much buying and selling. So what's called velocity is pretty much not there. Banks are being careful about who they lend to. That's all good. We're getting older. The boomers are keeping inflation down. Technological advances really are. I mean, just think about flat screen TVs and how powerful and wonderful they are, and cell phones and all that stuff. So things are getting cheaper. We've become energy independent. So energy prices are down. So all those things are likely to keep interest rates down. But we are fooling with and gambling with the helicopter money on the right-hand side. Some amount of helicopter money, and nobody knows what it is, will bring us inflation. And that's virtually guaranteed. I don't know what the number is. You know, is this 7 trillion heading to 11? So will that do it? I don't know. Maybe it's got to be 111, but some number will do that. So I want to leave our listeners with something that they can implement on the next page. So I do want to say this about our show. I know there are other investment types of shows, and if you listen to them, they normally end up with, these are the 3 best mutual funds. Go out and get them now. Very little concern about whether you're a boomer or not. I think we're the only one who really is trying to give our fellow boomers some warning. So our number one warning is you're probably too risky at 60-40, and you should move to safety. I think right now, cash is probably a reasonably good, safe place to be. But be aware that cash as money might not work and won't work in hyperinflation. So if you want to protect your savings, you need to be thinking about, and maybe not right away, but be thinking about at least moving some into precious metals, probably gold. Cryptocurrencies, like we talked about in our last episode. Now, the cryptocurrencies are sort of like money, but they're definitely a gamble. They have been very volatile. So what Maureen McCoy was basically saying, and you need to listen to the whole show, is it's still pretty early in the life of cryptocurrencies. And if they catch on at all, they could become worth a real lot. Others, like UBS, has just come out and said they could become zero too, which is probably true. I don't know what scenario would bring them there, but no. So we're not selling cryptocurrencies. They're just in the list. So we can get back to the list, Kath. Treasury inflation protected securities tips should work. I mean, there's always a possibility that the government would renege on those, but if they do, it's really gotten bad. Consumer staple stocks, even though stocks are not safe on their face, people have to eat. So that's where these last 3 come in. Consumer staple stocks, commodities, especially energy and food, and real estate like farmland would be a good investment. So on the left-hand side, we're talking about printing the money, and there's a theory called modern monetary theory, MMT. And that is the justification for just printing as much as you want. And the theory is really, I think, a little more developed than most people give it credit for. The real idea, I think, and I've been told I really don't understand it, but I think I can come close. The idea is you can solve your economic problems by printing money. But, and this is a big but, you need to monitor inflation. And if inflation starts to rear up, you need to suck that money back out of the economy. And the vacuum that sucks the money back out of the economy is taxes. So, is there anybody on this call who really thinks when we've now triggered hyperinflation that there'll be any political interest in going back? when, when dollar bills are worth nothing and you say, now we're going to tax you a lot. I mean, in one way, maybe people say, fine, take all you want because it's not worth anything.
Yeah, right, right.
But no,
So then if that happens, then how do people barter and exchange with each other?
Real goods. So
Okay.
precious metals, cryptocurrencies, things like that. There has been hyperinflation in other places, and they pretty much had to rely on a while for a barter kind of society. Some people got filthy rich. So where there's risk, there's opportunity. So I even say this: one of the people who own their homes and maybe thinking about converting that to cash. I don't know. You might want to think about that twice. So that kind of stuff. Then on the next couple of slides, we're pretty much up against our 45-minute clock, so I'm going to go pretty quick. There are many things that could burst the bubble or deflate it. One of those things is if interest rates rise. And I said when ZIRP ends. ZIRP is zero interest rate policy. So if you really believe that the Fed can keep interest rates at or near zero forever, there's no risk. I don't believe that. I just don't. I mean, they just need to keep. And there's this. It's one of these things people have said the Fed cannot stop printing money now. So in order to keep interest rates artificially low, which is what they've been doing, they're just going to need to print and print and print, and there's got to be some limit to that. So I'll just say, in my opinion, interest rates will increase, and when they do, what will happen is on the next slide. So we have this house of cards, and everything will roll around fine, and all these positive forecasts will come to be, as long as the Fed can continue with the zero interest rates, and as long as modern monetary theory works. And I think part of what that theory says won't work, because I don't think when the time comes, Congress will move to increase taxes, not in the amount that they need to do. So when interest rates rise, stock prices will plunge, because now future earnings will be discounted at a higher rate. There'll be the pin that bursts the bubble. Interest payments on our national debt can only be met if we limit some other spending, like welfare and military. We talked about Social Security and Medicare. They're expected to go bankrupt soon, so they'll certainly be in jeopardy. And then inflation will escalate even more, because we will be forced to print money to pay the debt, to pay the interest, and we'll just print and print and print, and something will break.
Yeah, it just seems like it's a vicious circle or vicious cycle at this point.
It's just the debt spiral. People have written about it for years. Some people, my bride is on this show, and she says, you've always been a pessimist. I haven't. I started being a pessimist in 2008. And what happened then was catastrophic. I think what bailed us out on its face makes no sense. So we solved our spending problem by really spending more. It's really what we did. That's quantitative easing.
Oh, wow. Well, I'm in for that.
Yeah. So I've been concerned since 2008, but I think this COVID really should have burst the bubble. And I think what happened after the market crashed 35% and between February and March, the millennials and other investors have been trained to buy the dip. So the market bubble was there coming into 2020. There was some correction as people reacted to the COVID, but the economy did not come back. So the bubble is even bigger now. So I'm worried. So the next slide, Kath, is what we did in, I think, our 11th show. We did this in the when the market came down in March of 2020. Everybody was reading Buy the Dip, and in particular, Stay the Course was everywhere. You read something, you pick up your email, you say, "Well, stay the course. This is going to get better. Stay the course." So we did the show, and this is our second most popular show. We said, yeah, stay the course is a good idea. Excuse me. Not the COVID. If you're on the right course. And baby boomers generally are not on the right course. They're the 60-40. So I'll keep on reminding you. Then the next slide is when we do every show. And I just want to, first of all, ask you for help. Please go to YouTube and Facebook and like us and do all that. If you would like to support us financially, we are on Patreon, where you can support our efforts. But also, we can help you. There are 4 websites here. 8 Sage Robo is for do-it-yourself investors. GlidePath Wealth Management is for people who want consulting help. The Baby Boomer Investing Show, you can visit our library. I think you'll what I basically say there is, if you have a question, we can pretty much answer with a show or an article in less than an hour. And then for fiduciaries who are watching this, we have the smart funds that are collective investment trusts for 401k plans. So I thank you all for listening, and hope you all stay well. And thanks.
Okay, well, what a great show. I'm sorry. I had to put myself on mute because my dog, Charlie, has been barking in the background. Yeah, I'm sorry. I should have put him in the other room. I'm sorry, guys.
Charlie's a good dog. So for people, I just want to remind you, our next show is going to be with Dr. Kotlikoff. And you can spell that name phonetically and you'll find him. He's written a lot and has really been screaming from the mountaintops that this debt thing is much worse than everybody thinks it is. And so if you really want to be scared and get it from a real
watch the show.
We'll have.
For those of you that want a copy of the slides that we just showed, I put it in the descriptions, or not in the description, in the comment section, so that you can link to the slides, and then you can actually link to the hyperlinks. Great. And so that's it. Okay, everyone. Great. Well, thank you so much. Love the show.
Thanks. Bye. Thanks, guys.